So let's talk about how to trade triangle chart patterns like a champ. Now, chart patterns are well documented in technical analysis literature, and they're based on a psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading strategy or system, but rather provide an indication of future trends of an asset's price as it breaks key psychological barriers in the form of support and resistance. Now that was a mouthful, wasn't it? I promise I'm not going to make the rest of it this long. So I'm sure you have heard about chart patterns on online trading and their relationship to technical analysis. Now, most people or most novice traders, when you mention the word technical analysis, automatically think about technical indicators. Now, technical indicators like MACD and RSI and stochastics make up one little sector of this overall field of technical analysis. There are many parts of technical analysis. So those are actually called technical indicators. Another important part of this is chart patterns. And chart patterns are probably one of the most well-known, well-used part in Forex trading and online trading. And you've probably heard about double tops and triple tops and head and shoulders and rectangles. So in order to have a complete understanding of chart pattern trading, we should also gain a good understanding of one of the most common on-chart formations, triangles. So let me share a little screen I have for you. Here we go. And what I call this is market structure. There are many, many patterns out there. Double tops and double bottoms, triple tops and triple bottoms aren't really parts of what I call chart patterns. They're just visible steps. Chart patterns are made up of things like bull flags and bull pennants, descending wedges, ascending wedges, ascending triangles, descending triangles, bull flags and bear pennants. Okay. And there's also a thing you've all read about it, you all seen it, is head and shoulders and inverted head and shoulders and a cup and handle. Okay. There's lots of gurus out there giving you all kinds. I've seen bat wings, I've seen but these are not standard. The standard ones are like the ones you see on your screen. Of these, I group a lot of these into what I call triangles. Because I don't care whether it's an ascending triangle, whether it's a descending wedge, because a wedge to me is just a triangle. It's just that the upper line and the lower line are moving on different angles. Okay, but they're still forming a triangle. So it's like an ascending wedge. Then we have a bear pennant. Okay, all of these to me fall into the study of triangles. Now, the reason they're all named something separate is a lot of people want to tell you when you see a bull pennant up here, this is what you should expect. And it's a bearish or a bullish characteristic, and you should be prepared for a continuation pattern. Well, let me tell you, I've tested this over and over and over again. In fact, I've run 700 tests to find out if this is true, if a particular triangle, a particular pattern really had a high percentage of doing what the characteristics said about it. And I found that it doesn't. And therefore, for me, it's not worth my effort to trade something that doesn't give me a high probability. But triangles on the whole give you a very high probability of success if you look at them correctly. If you can get past the bearish characteristic and the bullish characteristic and try and forget what they're supposed to do and realize the only thing that controls anything is price. And what's important about these is they're telling you that the markets are moving into an apex of a triangle. Let me pop up, hold on a second, a different triangle chart for you. And when price moves into this triangle, it forms one line, one angle, another angle. And as it moves in, it gets tighter and tighter and tighter. Now, there's no rule about when a price will break out of a triangle. There's no guarantee of anything. But when price does move into a triangle and then breaks out either upward or downward, and that's the only thing that you know, okay, is when it breaks out. Which direction did it break out? In this case, we see a breakdown. But it could have just as easily broken up. But if you start fooling yourself into saying this triangle pattern has a bearish characteristic or a bullish characteristic and try to preset your trading, you're going to miss a lot of opportunities and have a lot of false or bad trades. Now, there's certain ways that we can take triangles and make them work very successfully for us. Because when we have a triangle formation, and we have, like I said, we have symmetrical triangles, we have ascending triangles, we have descending triangles, we have wedges, is that we know as price moves into this apex, it's going to do something. When it does whatever it does do, we can verify it's not a false breakout, and then we can apply our triangle strategy and trade in the direction of the confirmed breakout of a triangle. So we want to get away from the preconceived notions of the characteristic or which way the market should go when it breaks out of a triangle. So let's go back to my PowerPoint for a second. So the triangle pattern is a specific figure formed on a price chart, typically identified when the tops and the bottoms of price move towards each other like the sides of a triangle. When the upper and the lower levels of the triangle interact, traders expect an eventual breakout of that triangle. As such, many breakout traders use triangle formations to identify breakout entry points. Now, in that whole statement there, I didn't say whether it breaks out upward. I didn't say whether it breaks out downward. I didn't say what the pattern said. I didn't say anything about what the trend is telling. Because ultimately, the only thing we can know is we expect an eventual breakout. Once we get the breakout, then we would jump into action. So we have the standard triangles, the ascending triangle, the descending triangle, and the symmetrical triangle. Symmetrical triangle is just defined as when the support and resistance lines, the lines above and below price, are moving at the same angular degree. Now, the rule of thumb is, and it's a very well-known rule that everybody applies, it's not a Berry rule, is that the width of the base of the triangle will equal the momentum of the breakout. So we can, when we get a confirmed breakout, set our target point so that we can figure out our risk management, our risk reward ratios, and we can set the target point at the width of the triangle pattern. Now, going back to my chart, the base of the triangle to get the width of the pattern is when both lines are forming the triangle. Because you'll have times where the upper support line has been holding for a long time, but you don't have this bottom line to draw. So it's at the point, excuse me, is at the point when both of those were existing for the first time simultaneously. So again, here, our width would not be here. Our width would be measured from here. And this is the base of the triangle. We can then calculate our basis by taking this height and at the breakout point, taking that to use it to set our target. There's some rules that are involved here. It's not that simplistic, but there are some rules that we have to make sure that we have. But we'll get that in a little bit later when we're learning how to use this in our strategy. But this is the general rule of thumb with triangles. And it doesn't matter whether it's a symmetrical triangle, ascending triangle, descending triangle. Regardless of which one it is, it's the same calculations. So we have ascending triangles and descending triangles. The difference between ascending and descending is one has a horizontal support and one has a horizontal resistance. It's just really one forms in the midst of an uptrend, one forms in the midst of a downtrend, because that's the only way that they can happen. But we would still apply the same rules. So it's very important to mention that an ascending and descending triangle sometimes break through the incline level, causing false signals and trap some traders along the way. The same holds true for the horizontal price zone. You should always try to wait for the close of the candle to confirm a breakout. This will help us reduce the number of false signals. And this is very, very important when we're trading triangles, because a lot of times you will get a false breakout, or you have a price pop out of the triangle just to go right back into the center of the triangle. So if you are anticipating a break upward, and you see the price break out of that pattern, you tend to go and jump in and make a buy, and you end up getting losses because the price goes right back into that triangle. So it's one of the things that we don't want to do. Pennants just have a little bit definition than a triangle, only because pennants are defined by the trend in which they appear. And this gives them a very particular characteristic. So I don't want to go starting talking about pennants, because it can be very misleading, and then you start thinking that they're bullish or bearish, and you get hung up in this idea of where they should go. So we have symmetrical triangles, rising wedges, bears, pennants, increasing. We have all types of wedges and all shape. Basically, for a triangle, you have an upper and a lower, lines that are moving into it, moving closer and closer together, and prices moving between. And you get the triangle formation on your chart. So I'm going to share with you a little short presentation, which will show you this in an animated format. And just to help you, it's only going to last a couple seconds. And it might help you better see a triangle. Triangles are quite easy actually to notice and see on your platform.
The symmetrical triangle pattern is formed by two intersecting trend lines of similar slope. These two lines are converging at a point called apex. The coiling of price that happens inside the triangle will eventually result in a breakout. The breakout can occur in any direction, and the move is often as big as the base of the triangle. The ascending triangle pattern is easily recognized by a rising trend line intersecting with a flat resistance line. It is often regarded by traders as a bullish pattern because the price keeps bouncing off a resistance line that may eventually be broken. That descending triangle pattern is formed by a descending trend line intersecting with a flat support level. The repeated attempts of the sellers to push the price down can result in a breakdown through the support line. In all cases, the stop loss can be placed beyond the opposite trend line. The stop loss distance can be at least as big as the distance between the trend lines, measured at the moment of the breakout. A good place to place the take profit level is considered to be as far from the breakout point as the triangle base is wide. Choosing the take profit distance a little smaller than the base width, if the risk-reward ratio allows it, can increase the chances of price reaching it. These chart patterns have no predictive properties, but they may give hints about the forces involved in the market.
I hope you were able to hear that because I couldn't hear it through my headset. There's just some weird internet things going on today. I don't know what they are, but hopefully you heard that. But you could see the visual presentation there. So now, how can we trade triangles? Okay. The first thing about triangles, whether they're symmetrical, descending, ascending, whether they're pennants or is they will help us set our buy point or our entry point to a trade and help us place our stop loss. Okay. So once a triangle is identified on a chart, traders will wait for a breakout either above the resistance line or below the support line. After the breakout is confirmed with either a closed candle above resistance or below support, a stop is placed about 10 pips below the last swing low of the triangle. A limit equal to the height of the triangle is then placed. So let's go back over to my triangle charts. So in other words, once we got this breakout candle here, let's see if I can make this bigger so you can see it a little bit better. Okay, so once we got the breakout candle here, okay, that's telling us, okay, we have a breakout, but you're not ready to trade yet. Okay, it's just broken out. Now it's telling you want to consider, since it broke out upward, you want to consider a buy. Okay. Now, how do you verify this? Well, the first thing you want to do is you want to set your stop loss about 10 pips below the last swing low. So the swing low inside the candle was here. So this is where we would want to set our stop loss. Our take profit point would be the width of the triangle, or here. And then our entry point would be the close. Okay, our entry price, not that we would enter, not our decision, but our entry price would be the close of the breakout candle. Okay. But we haven't confirmed the breakout. Now, there are some important things we have to also look at here, because at this point, we can quickly set our risk-reward ratio. So we've got to put our stop loss here, our take profit here, and our entry point here. We can calculate our risk-reward ratio, make sure this fits into our risk management. Okay. The thing is, if you have a major resistance area on your chart, here, you can no longer set your target here because the target cannot exceed the next major support or resistance price. So therefore, if you have one in between, you'd have to set your target, reduce your target to that resistance level, and then recalculate your stop loss and recalculate your risk reward ratio. And that's very, very important, because most likely price will get stopped at that next resistance level. The other thing you need to see is by the time we're in the second candle after the breakout, is that there's an increase in volume. If volume is remaining flat or decreasing, the traders do not believe in that breakout, and therefore you can't make that trade. If volume is moving upward, if you can set your stop in your right place, your risk reward ratio is correct. Okay. What we do is now we placed our entry point at the close of that breakout candle. The second candle after that is your confirmation candle. That second candle must close outside of the triangle. And then on the next time frame, when price reached that entry level that you had set, you would then initiate your trade. Because there's going to be a lot of trading opportunities you miss because price falls back into the triangle and then pushes outward. Okay. But you won't get any of the false signals and bad losing trades. Okay. So you notice here, price pushed out, pushed up. You would have entered a trade here, put your stop loss down here. Now it eased back down, but it never went back into the triangle. And then it took off going upward. Okay. It hit our first target where we had to revise our target too. And we would have exited the market here and we would have been out before there because it didn't reach up because we couldn't put our major target up here. But we got in here, we had our profitable trade, we did everything right. So on this triangle, so we had the breakout candle. We set our entry point here. We had our confirmation candle. And then on this candle, we would enter the trade going short, with this being our profit level, this being our stop loss level, and our profit level down here. Let me pull the chart up a little bit. And we would have far exceeded our profit level. Okay. But we had to see that jump in volume. It doesn't have to be a big jump in volume. It's just got to be a climb in volume. And we can see we got the climb in volume. Okay. And all of our pieces of the puzzle were in place. Stop loss, entry point, is that about the width of the triangle, our target, and we had all the key pieces we needed to make that trade. But the key is waiting for this third candle so that you don't get sucked into false signals. So as you can see on this chart, same thing. We could set our stop loss. We had our break. We set our entry point. We set our limit. And then we waited for that third candle to enter the price at the close of the breakout candle. Again, we have the exact reverse. We place our stop loss. We'd put our buy point. We'd set our target. And our stop loss is set close enough that if it does swing back in, we don't lose our shirts. But when we get stuck in that idea that it should be a bearish or bullish characteristic, we make our mistakes. So here, stop loss at the low, the lowest swing low before the breakout. Our limit order based on the width of the triangle. Our entry point, and off we go. So again, you can get stuck in the ascending, descending triangle, the symmetrical triangle, the bullish, the wedge, the bullish flag, the bullish pennant, the bearish pennant, and you won't get much. It's all the same set of rules regardless of what's going up or down. It's all based on where the price breaks out in the direction of the break. So how reliable are candles? So like I said, I mentioned to you earlier that there's a lot of people who want to start with this bullish characteristic and it should be a continuation or it should be a reversal all ahead of time when a pattern starts to exist. But the fact remains that To get an idea of a pattern's reliability, I've analyzed the charts of 5 major currency pairs, and I've looked back over a 10-year period. And we looked at a 4-hour chart, and I found 165 beautifully formed symmetrical triangles. I measured the trend using the slope of the simple moving average. And if the breakout after the triangle was up, as the trend was up, it was classified as a correct bullish characteristic. When the breakout was down and the trend was down, this was classified as a correct bearish move. Patterns where there wasn't a clear trend were completely ignored. So when you do this in a 4-hour chart, you can find that when you projected a bearish move in the Canadian US dollar, the CAD, we were 61.5% correct in our early prediction. When we saw a bullish triangle, we were only 57% right. But that being the Canadian dollar and Japanese yen, we were only 33% and 40% right. Overall, measuring the 5 currencies we use for our analysis, we were only in the area of 54% being correct. Well, that's not enough for me to make a major trading decision. I need other pieces. So don't tell me that this particular triangle is going to give me a bearish or bullish move, because I'm at 50-50 with a breakout up or down using price. So it's not enough, big enough percentage to make a difference to me. And when I broke it down to a 1-hour chart, we were down at 51%. Well, that's not enough for me to make any trading decision. So I don't care about the characteristic. I only care about what price is telling me. So even though the numbers are quite small, this does give some objective data on the reliability of symmetrical triangles across 4x pairs. When you throw those in the trash, add on just analyzing it based on the price breakout, waiting for the third candle, and looking for that surge in volume, you move up to about a 75% success ratio. Now you have to make sure everything are moving in your favor, but when you do, you'll find that you will be quite successful. When the pattern ends, the volatility dips to a minimum and support and resistance lines will be very close. The market will then usually start to show some preferred direction. Now there's no guarantee of this. However, as always, it's best to be prepared for false breakouts and retests of the support and resistance lines. The easiest way to trade this chart is to treat it like a continuation breakout. Here, just wait for a clear break above resistance in a bullish trend, or wait for a clear break below support line in a bearish trend. While there are instances when symmetrical triangles mark important trend reversals, they more often mark a continuation of a current trend. Now, if you're a true die-hard trader that believes in the trend is your friend, you'll only take those bullish or bearish things based on the current trend, because you never trade against a trend. But with triangles, you do have the ability to do that, because then you're just trading the valid breakout. So what we want to do is we want to look at a trend in order to qualify as a continuation pattern. An established trend should exist, but we're not saying it has to be a long-term trend. It could be a very short-term trend. We want to look at volume. Volume is your key here. Volume is the thing that says, okay, you did everything right and the markets are thinking the same as you. As the symmetrical triangle extends and trading ranges contract, volume should start to diminish. This refers to the quiet before the storm, or the tightening consolidation before the breakout. Now, for us, durations is very, very important. We don't want a very long, slow-moving triangle. We want a triangle that pops up and moves relatively quickly, and a breakout comes because we're trading in short time frames. And of course, the breakout direction. The future direction of a breakout can only be determined after the break has occurred. Sounds obvious enough, but attempting to guess the direction of a breakout can be very dangerous. Even though a continuation pattern is supposed to break out in the direction of a long-term trend, this is not always the case. So a break should be on the closing basis for it to be considered valid. After the break, Okay, the apex sometimes the price still sometimes returns into the apex, like I showed you in the triangle. This is why we have to wait for that third candle. And then of course price targets. So to sum it up, triangles are easy to spot and provide good risk reward opportunities. Traders can quickly know that a big move may be near, as well as the profit objective and the amount to put at risk. Now that you have the knowledge of these three powerful price patterns, you are a step closer to becoming a more confident trader. So thank you very much for joining us today. If you notice on your screen, I've put together two handouts for you. If you look on your screen, there's something that says handouts and has a downloads. These are two PDFs. There's nothing you have to sign up for, nothing you have to pay for. Just click on the download and you'll download one is a breakout of all the chart patterns and the stuff we talked about today. And then there's the Introduction to Technical Analysis Guide from investing.com, which is a great resource library. And it gives you everything you want to know, not just about chart patterns, but it has a section on all technical analysis, technical indicators, chart analysis, price analysis, and chart patterns. So make sure you click on the download button because these are only available in the live class. And once again, if you have any questions, go to www.alvexo.com, click on their chat button or send them an email, and they'll talk to you one-on-one. They'll set you up with a time to talk to a financial analyst who will explain to you all about chart patterns and answer your questions. So thank you very much for joining us. Have a wonderful weekend, and we'll talk to you again next week. Bye now.